The next question, this one's from Shelley. So, funnily enough, I actually had this identical question with a client on the phone just before this call. So having this slide prepared was fairly handy, to be honest with you. So we're in the process to buy with you guys within our SMSF structure, i.e., some renovation is ruled out. So we can potentially buy two at least at 550 each maximum, stretching to 2 times 600,000 would be tough, though there may be limited properties to choose from in today's market, question mark. So we're considering buying one at a higher price point, $750,000 to $900,000. Is that wise? What are the pros and cons? What would you do? Please share your thoughts. Thanks. That one's from Shelley. So to Shelley's question here, this one's a question we've got quite a bit, not always related to SMSF, but it's whether you should buy two properties at $500,000 or one at $1 million. This one's a little bit different because we're asking about, potentially $1.1 million worth of investment across two properties, or let's call it an 850 purchase. There's a few things to unpack. So first thing is the spec of your property, right? So if you want to get into a higher spec property in, say, a regional location, you're probably going to be more, because this is a couple of months ago, probably more towards a 650. Yield comes down, less wear and tear on the property, same as this purchase here. We come into maybe a metro location, price is a little bit lower, home's a little bit more dated, yield's a little bit lower because we're in a metro location, and so on. Get a bit of a nicer property, the price goes up, yield goes down. So the first thing, I guess, that the pros could be is that if you've got the two properties at $550,000 each, you're diversified more because you're spread across potentially multiple markets. The other one there is that you got a higher gross yield. So typically speaking, you're probably going to be at a five, let's call it high fours to early fives in that gross yield. You're going to have potentially, you could argue, you're also going to have more buyer demand. Though I would probably say in this example, if we were saying two 550s versus an 850, I would probably argue against that. If we were saying two 550s versus a $1.1 million, and potentially, but you're going to have more competition at the lower price point just based off affordability. The cons will be, so particularly in super, you want to speak to your accountant or if you're using a financial planner, they all charge different fees. If you've got multiple trusts, etc., to manage, they might charge you more. Also in super as well, depending on the state you're buying in and the value of the property, the threshold on land tax is lower. Some of them will be straight away, so you might have more costs there to be wary of. You're then also going to have two sets of council rates, insurance, property management fees. That also includes double the, I guess, the renovation spend or capex spend, right? So dishwasher breaks, aircon breaks in the $550,000 property versus the $1 million property. The replacement cost is essentially going to be the same. Potentially, though, the con is also about the stock availability. So it is getting harder to find two quality properties in this price point. I'll get into that a bit more later on as well. Now, the pro will be on the more expensive side. Easy to manage, one tenant, one insurance, one property manager. Potentially, you could also argue as well that you might have a better quality tenant. So what I mean by that is the more expensive you go in property or locations, potentially income earners are higher, etc. But again, that's maybe not always the case, but just being very generalized. Potentially better land component. I'd probably say yes and no there as well. Depends on the size of the home. You might have a newer asset. So again, depending on the spec and the price point, you might be able to get you something that's a little bit more renovated, newerish build. You definitely will encounter a lower yield at the higher price point. You're going to be less diversified. And I guess the other thing is as well, if you're tied to one area, whether you could argue that you haven't diversified, so one's performing, one's not, you're just basically all sitting on that one location. The other thing I would say to your question here, Shelley, and to the other person I spoke with today as well, the other thing, and this is where you need to really sit down with your, whether it's your financial planner, whether that's your investment lender, whether that's your accountant, in terms of in super, is this purchase? Because if we're just looking at it really simplistically here, we're talking about buying an asset potentially in total worth about $1.1 million spread across two assets, which means, if you're getting a 10% return on that 1.1 million, you're making $100,000+ each and every year for the next few years. Or alternatively, for a $750,000, $900,000 purchase, we're going to be getting $75,000 to $90,000, which obviously compounds as well. So that's the first thing to consider. The more you've got invested, I guess simplistically speaking, you're going to get a better return just based off your total investment. That's again assuming we don't know. I don't personally know how much you're going to be leaving sitting, whether it's in an offset facility, whether that's going to be tied up in another type of investment. It's really hard for me to know just off a really general question here as well. The other thing to sit down with your investment lender, broker, bank to discuss as well. If you're buying that, let's call it a $750,000 property, how much cash does it leave you left over with? And if your goal is to keep going down the property pathway, which knowing Shelley it probably is how far are you away from having enough borrowing or funds to be able to get the next purchase? So if the bank turns around and says, hey, well, if you buy this property at 750, you're still $100,000 short of being able to purchase another $500,000 property. So as soon as you get that $100,000, we'll help you. You're going to have enough funds in there to be able to do that. Or is it that you need $200,000 and off contributions, that might take you another 5 to 10 years to make? So that's the thing to weigh up, where if you can get straight into the $1.1 million worth of property now, you might be best placed. So that's the other thing to just weigh up in terms of, as well as if you knew though that at $800,000 you couldn't buy another property soon, you're probably actually best to try and push yourself towards the 9 in general, because again, you want to utilize as much of your leverage of your borrowing. That's the whole advantage of what property, I guess, offers you versus other investments. It's leveraging that asset against the debt that you're taking on the property. So if you're leaving money on the table, you're typically reducing your return on your investment as well. But so again, there's no real correct answer here. It's really depending on what suits you best in terms of, do you want the newer property? Do you want the simple one property to manage? Or is it just purely about, I want to have as much of an investment as I can, hold as many properties or as much net value as I can? Well, that's when you go down the 2. But it all comes down to what's going to make you feel comfortable, what's going to allow you to sleep at night. If you're going to look at regional properties that you're just not going to feel comfortable on pulling the trigger on, you might sit out of the market for 6 to 12 months and you've missed out on returns there as well. So there's no right or wrong answer. That's just something to take in mind there as well. But thanks for flicking that one through, Shelley.